Welcome back, students who are taking financial accounting, and in this series of videos we are covering the theory from chapter 8, which is about long-term and other assets. So in this particular video we are going to be talking about, let me get there, come on, where is it? Nope, not the cost repair. Yeah, okay. We're going to be discussing the disposal of the fixed assets. So with the disposal of fixed assets, the concept isn't that difficult overall, but doing the math for it is difficult because it is highly individualized to each and every possible situation. On this slide here, you see that I have written a like-a-kind exchange, and I'll talk about that last here. But when it comes to the disposal of an asset, think about it this way, and I'm just going to make stuff up here instead of using numbers that are in the book, because obviously you can follow the numbers in the book, but me making up numbers also helps to take a different look at it. But I will use the idea of an automobile. So you have an account automobile, and let's say you pay $50,000 for it, or you buy for $50,000, and your accumulated depreciation is, I don't know, let's say 30,000. Okay, that's what's shown on your books. Okay, now the thing here is that what you want to do is you need to remove that from your books. So you would think, well, that's relatively easy in that since since the auto account is an asset and we debit the asset, then I would credit, my auto account for 50,000. And since the accumulated depreciation account is a debit, I would debit accumulated depreciation for the 30,000. Okay, but now remember, debits have to equal credits. Okay, so basically, what you're looking at here is you're looking at either a gain or a loss on the asset. Okay, so in this case here, let's just say someone pays you, I don't know, they excuse me. Let's say somebody pays you $10,000 for that asset. Okay, so you're going to get cash for $10,000. So we're going to debit the cash for $10,000. Okay, and the difference between our debits and credits, right? In this case here, our debits are 40,000 and our credits are 50,000. So the difference between the two is 10,000. So what we have here is we have to have a debit for a loss on the disposal of the asset of $10,000. Okay, in order to make our debits equal credits. Basically what you're doing is you're backing into the gain or loss. Now, the book does say, and it's good to kind of like follow the steps in the book, think about it from that perspective. Step one, it says record what you got. What you got. And then step two, record what you gave up. And then step number three is to record any gain or loss. Record the gain or loss that you recognized on it. Okay, so here was our, here's what we have on our books. Now, we're going to record what we had got, right? So what we had got was cash. Okay, we had gotten $10,000 in cash. And then we record what we gave up. Well, what we gave up is the automobile and the accumulated depreciation. Okay, and then you kind of like back into, your gain or loss. So we back into the gain or loss, right? And, if you follow those 3 steps, for the most part, that it should be relatively easy to be able to figure this out. Okay. However, I said it's not easy because there's, a lot of math involved, right? For example, you know, remember it's a highly specialized, highly individualized situation. I mean, you have this here auto, which you're booking at 50,000, and you have your accumulated depreciation of 30,000. Okay, first things first, before you can even consider disposing of that asset, you have to think about your accumulated depreciation. You have to fully depreciate up to that moment in time, whatever accumulated depreciation can be captured for that auto. And that takes, when you're doing that, that takes into consideration the prorating, which we covered in a previous video, the prorating of depreciation. Now, I didn't, I had said in the previous video when we talked about depreciation that you really kind of don't have to worry about it that much. I mean, I had gone and used the example, let's say this here is March, and this goes to March of the next year, okay? And you're buying the vehicle, that vehicle in March, and when you get to December, okay, you have however many months, 9 months, 10 months of depreciation, okay? 10 months of depreciation because you're buying March 1st, all right? You have 10 months of depreciation, so you're kind of like prorating the 10 months, for that particular year. Let's say this is 2015. You're prorating the depreciation for the year. You're not capturing a full year's worth of depreciation. Conversely, in 2016, you're kind of like prorating, 2 months worth of depreciation in the year 2016. And that's kind of like how I presented it. And when you're just thinking about the depreciation on a fixed asset, and you're going to fully keep the asset, and you're going to fully depreciate it, you don't really have to think so much about prorating, okay? But let's say we have the situation where you're going to buy it in March, but now we're going to depreciate it in March, but we're having, let's say this is 2015, this is 2016, this is 2017, and this here is 2018, and this is 2019. Okay, so you're going to depreciate it over this amount of time. Right? Well, what happens when you decide to sell it right there? Okay, right here. Right. So in here, I'm sorry, not there. In here, this part here from January to, let's just call this June. Okay, you have 6 months of depreciation. Okay, you have to, depending upon how you're keeping your books, you have to bring your accumulated depreciation up to date, up to the point in time where you're disposing the asset, and therefore you're going to have to think about how much, how to prorate the depreciation for that period of time so that your accumulated depreciation is accurate. Now, I'm not going to go into a lot of examples here because, like I said, each one is individual to that particular asset. I can give you 100 different examples, and none of them will be applicable to the next asset that you're going to dispose of. Right? What you have to consider is the entire concept of the disposal of the asset. And part of that disposal of the asset is the first thing you do is you make sure that your accumulated depreciation is up to date. And if that means prorating your accumulated depreciation, you have to figure out the math in order to make sure that you've got the correct amount of depreciation up to that point in time. So let's just say my depreciation was, say, 28,000, and now I'm going to dispose of this automobile, and I think about my depreciation, and I have to book an additional $2,000 of depreciation. Well, I booked the $2,000 of depreciation, which brings my depreciation up to $30,000, which is what it should be when I go to dispose of it, right? So that is kind of like a step that you have to do before you record what you gave up. Now, whether you do number 1 first or number 2 first, personally, I would do number 2 first, all right? I would record what I gave up, all right? And as you saw me putting these numbers, I had started out with, my auto at 50,000 and my accumulated depreciation at 30,000. And when you saw me starting to make this journal entry, I credited the auto first, and then I debited the accumulated depreciation. Well, what I was doing, for me, I do number 2 first, because immediately I'm just thinking about what I take off of my books, right? Then I did number 1, what I got. Now, could I have done number 1 first? Sure. Okay, I could have said, okay, I got cash for $10,000, so I, number 1, booked my cash for $10,000. Then number 2, I booked, record what I gave up. Okay, whichever order you decide to do it in, that's up to you. And there's no right or wrong way to it. I just happen to, take things off of the books first. I do number 2 first, then number 1. But then third, you have to record the gain or loss. So it's basically, you're looking at your debits, total of your debits, and you're looking at the total of your credits, okay? And you're kind of like saying, all right, well, my debits less my credits, what do I end up with? Which one is short? In this case here, I'm $10,000 short on the debit side, so I have to debit my gain or loss on disposal. In this case here, it's a loss because I'm not getting enough money. Okay, I mean, I'm supposed to have $50,000 if I've totally depreciated it. Now, if I had gotten $20,000 of cash, then I wouldn't have a gain or loss, right? Because I'd have 50,000 is equal to 50,000. And if I had gotten $30,000 in cash, I would have a gain, right? So let's look at it that way. Let me erase some numbers here. Oops. If I had gotten $30,000 in cash, okay, now I have 60,000 for my debits and 50,000 for my credits. So that means I have to credit my gain on the disposal of the asset for $10,000. So my debits equal my credits. So you're basically backing into your gain or loss, okay, when you do step number 3, right? So this process overall is relatively easy to understand, okay? If you just follow along the steps and you keep that thought process here of record what you got, record what you gave up, and then back into the difference as a gain or loss, right? You should make your journal entry easy. However, just realize that before you go ahead and do that, you have to make sure your accumulated depreciation is up to date. And in this case here, I'm just talking about receiving cash. Okay, a lot of transactions you might, is it possible to receive a note, like a note a note on that transaction? Sure, you can have a note. You can have a loan, right? You can somebody might buy it with an exchange of other equipment, right? There's a lot of different ways of going about disposing of that asset, okay? And again, it all depends upon the situation. You just have to, basically think about what you're doing. I mean, if you're going to receive equipment in exchange for that, okay, well, instead of having cash, you would set up another ledger account with whatever the equipment is, and let's say it was for $30,000. Well, instead of for cash, I'd have a debit to equipment for 30,000, or maybe let's say instead of having maybe the equipment, you're going to get, say, $15,000 of fair market value of equipment, and you receive cash for $15,000. Okay, excuse me. So you see, it's just a matter of thinking through what you're actually receiving, what you're getting and what you're giving up, and making sure that you're increasing your assets and decreasing your assets appropriately. Now, hopefully that you understood all of that. Um, and that's if not, watch the video again. Read the textbook. I mean, they do give you, it does give you some decent examples there. And of course, you have your homework problems that you have to work through. But now let's just talk about this here idea of the like-kind exchange. Okay. This idea of a like-kind exchange is a lot more advanced topic. Okay. Like-kind meaning, it says here in the book, since 2005, the distinction of similar versus dissimilar has been abandoned by GAAP with regards to exchanges. Okay, so what that means is that, like, let's say this automobile was a truck, okay, and you're going to exchange it with for a van. Okay, this would have been a like-kind exchange, okay, because they were very similar. All right. Now, if I had a truck, and let's just say it was a bigger truck, let's say it was a Ford F-350, and I go and I exchange it for, say, a little Subaru. All right, they're dissimilar. Okay, that's not a like-kind exchange, even though they're both automobiles. Right. But since 2005, they've changed their mind about what GAAP means, and now they call it commercial substance. And this idea of commercial substance is now treated more fully when you end up taking intermediate accounting. Okay, right? So all of the accountants, just be aware that the thought process of trying to determine what a like-kind exchange is much, much more fully covered when you take intermediate accounting. For everyone else that has, like, business managers and marketing, just know that for a like-kind exchange, in the back of your mind, just keep it that, oh, I'm exchanging a truck for a van, something that's very similar. I know I'm using outdated terminology here, okay, because yeah, I can exchange a truck for a van, but if I don't use the van for the same purpose, it's not the same commercial substance, even though they are similar. Okay, but notice that we're getting into something that's much, much, much more in depth in determination. And at this level in taking financial accounting, we don't need to get way, way, way into that topic. And again, that's something for intermediate accounting. But in the spirit of understanding what like-kind exchange is, let me erase all of this real quick. Let's say, and the book does a good job of showing this. I mean, and I'll actually use the numbers out of the book, all right, just to kind of like go through the thought process. You have this truck, right? And it's your old one. It's the one that's on your books, and you booked it at 43,000. Okay, and your accumulated depreciation is 39,000. Okay. um, you're going to get a new truck, and that new truck has a value of 48,000. And remember, what we're talking about, the book value of the old truck right now is only like $4,000, right? So obviously you're not going to get a new truck, you know, worth 48,000 for only 4,000. You know, you're going to have to pay, and in this case here, they're paying cash of 42.5 in it, in addition to the old truck to be able to buy the new truck. So when we're recording this, and this is why I like to always go with, I start out with what you gave up first, okay? It just makes it easier in my mind, all right? So I'm going to credit my truck, which is the old one, for 43,000. Okay, and I'm going to debit my accumulated depreciation for the 39,000. Okay, and so that's part of what I gave up. What else am I giving up? Well, I'm giving up cash, right? I'm going to credit my cash for 42,500. Okay, because that's part of, you know, my purchasing the new truck. So now what am I going to get? Well, I'm going to get the new truck. Well, I have to book the new truck, create a new account for the new truck. Truck new, and that is for 48,000. Okay, so I've done step 2, I've done step 1. Now last thing I do is I record the gain or loss, right? So the difference, you know, what do I have here? 87,000, right? My debits equal 87,000, and my credits equal 85.5. Okay, so the difference between the two is $1,500, right? So that means I have to credit my gain, and in this case here, on exchange of assets, for $1,500. Okay, so now that's my journal entry right there. Okay, that's my journal entry to record the like-kind exchange of the assets, right? So, you know, this whole idea about the like-kind exchange, like I said, in this for financial accounting, just keep in the back of your mind that we're talking about exchanging similar assets, and the thought process is, you know, no different than um, you know, doing it any other way. Okay, you know, just go through the 3-step process. However, when it comes to those who are going to be accountants, just be aware that, you know, you're going to have a more full treatment of what commercial substance is when you get into intermediate accounting, all right? Because that's more of an advanced topic. It's not as simple anymore as, you know, similar. Now they're talking about it's gone from the item itself, in the case of a truck versus a van, versus the dollar amount of however you're going to use that particular item. All right, but again, that's a different treatment. So, um, you know, go ahead and reread read this stuff in the textbook. It's pretty self-explanatory. Um, Hopefully, you understood. You know, because I've given a couple of examples on how to make that journal entry. And remember, the thought process is very easy, but the math is not. Okay, the thought process is easy because, you know, here's your steps, right? You know, just follow those steps, right? And like I said, if you know you find yourself like me, I always do number 2 first, okay, and then I do number 1, right? That's just me. I mean, if you find yourself doing it the same way, that's fine. But if you also find yourself doing number 1 first, that's okay too. You're going to end up with the same journal entry. Um, I just have a, you know, I just find mentally the way I'm wired, when I try to record what I got, I, it just doesn't flow through my head the right way for whatever reason. But anyway, so just go through those 3 steps, okay? And also remember that you have to make sure that your accumulated depreciation, when you go to do the disposal, that your accumulated depreciation is up to date. And that means you're going to have to use that idea of prorating your depreciation, okay? Prorating the depreciation for whatever period of time that you're, up to that moment that you're actually disposing of the asset. So, that's the first thing that you look at. Then go through through the process, the step-by-step process. So bring your accumulated depreciation up to date, then go through the step process, and then in order to be able to make the appropriate journal entry. Right, and that's it for this video. If you still don't understand something, definitely reread the book, watch this video again, and if you're still not getting it, feel free to telephone and speak with an instructor. Okay.